Now, here's what's happening in the silver market right now. The number that should make you stop scrolling, 528,691,365.40 ounces. That's the ounces in trust figure printed in the iShares Silver Trust fact sheet as of December 31st, 2025. It's not a rumor. It's not a tweet. It's an audited style number in a formal document. And it matters because it tells you how much silver exposure the modern public can hold through a paper wrapper, instantly, with a buy button. While the delivery-grade metal system reports much smaller, much tighter categories when you look at what's actually registered for delivery. And that's where today's story begins, because this video is not about whether silver is up or down. This is about why the silver market can look cheap on a screen and still feel tight in real-world pipes. It's about why the same metal can trade like a speculative toy at 7:46 p.m. and like a strategic resource at 3:10 a.m. It's about why the dollar can nudge the paper price down, even while the physical system is quietly documenting withdrawals. And it's about why most people who watch the silver market every single day still don't understand how the gears actually connect behind the screen they're watching. At the time of these snapshots, Kitco's live silver page is printing a bid of 84.62 and an ask of 84.87, showing 1.17%, and a day's range shown as 83.02 to 89.54. In the same live charts area, gold is printing a bid of 5,139.80 and an ask of 5,141.80, showing 35.40, 0.68%, with a day's range shown as 51.30 to 110 to 52.24, ZUR. Those numbers are the part everyone sees. That's the billboard. That's the surface-level temperature reading that gets screenshotted, shared, debated, and weaponized by both bulls and bears before anyone stops to ask what's actually underneath the number. But here's what most people don't understand, and it's not their fault. Silver doesn't have just one price. It has layers, spot quotes, futures contracts, ETF proxies, physical premiums, warehouse categories, vault reporting cycles, different timestamps, different rules. And if you mix those layers like they're all the same thing, you will always feel like the market is lying to you. It's not lying. It's speaking in a language most people were never taught to read. Let's make it simple. Paper silver is the price you can click. Physical silver is the metal you can actually take, ship, refine, fabricate, and deliver. And those two are connected, but they are not identical twins. They are more like two siblings forced to share one reputation. One moves at the speed of a keystroke, the other moves at the speed of a forklift. Now look at the futures arena, the part of silver that can move like a knife because leverage makes everything sharper. CNBC's Silver COMEX May 26 page shows a last of 84.92 at 7:46 p.m. EDT, down 0.615, 0.72%, with open 86.065, day high 86.065, day low 84.75, priv close 85.535, open interest 78474, XP date 2026-05 to 27. That open interest number matters because it tells you one thing: the arena is full. A full arena can cheer. A full arena can panic. And when panic hits, the exits get small. Now think about what that means in practical terms. Every single one of those open contracts represents a bet, and every bet has two sides. When sentiment shifts, the liquidation pressure doesn't politely line up and exit in single file. It stampedes. And that stampede can take the price somewhere that has nothing to do with what's sitting in a vault. Now put the currency next to it because metals live inside the dollar's shadow. CNBC's ICE US Dollar Index snapshot shows 99.456 at 7:56 p.m. EDT, up +0.225, low 0.23%, with open 99.453, day high 99.466, day low 99.437, prev close 99.231. TradingView separately frames DXY at 99.252 and notes it has risen by 0.21% in the past 24 hours. That's not a giant move. But in a leveraged market, you don't need a giant move. You need a catalyst, and the dollar often acts like one. The dollar is the invisible gravity field around everything priced in it, and when that field strengthens even slightly, everything denominated against it feels heavier. So here's the first thing the audience needs to understand, in plain language. A firming dollar can push paper silver down fast, even if nothing fundamental changed about the metal in the real world that day. And when that happens, the narrative gets dangerous because people start assuming the physical world is loosening too. Sometimes it is, sometimes it's not. And the difference between those two outcomes is the difference between an informed decision and a reactive one. Now we go behind the curtain. COMEX warehouse reporting. This is where you stop talking about vibes and start talking about categories. This is where you separate the tourists from the operators. CME's COMEX Silver Depository Report dated 3/11/2026 with activity date 3/10/2026 lists total registered at 78,347,462.573 troy ounces, total eligible at 266,194,339.297 for a combined total of 344,541,801.87. Here's the clean explanation. Registered is the metal that has been warranted for delivery. Eligible is metal that meets specs but is not currently registered for delivery. Both exist. Both are real. But only one category carries the psychological weight of available right now in the delivery mechanism. And that distinction, the gap between registered and eligible, is one of the most important things you can learn about silver if you want to understand how stress moves through this market. And then the report prints something that should make you pause. Withdrawn 768,640.67 ounces on that activity date. Now don't turn that into a fairy tale. Withdrawals happen, adjustments happen, metal moves, classifications change, some shifts are accounting, some are physical. The point is not to scream shortage every time you see a negative line. The point is not to dismiss it either, because patterns matter, and single days become trends when they repeat. The point is this. While paper silver can drop on a dollar bounce, the physical system can simultaneously show metal leaving specific pathways. Those two events can coexist in the same 24 hours without contradicting each other, and if you don't understand that, you will always be confused by this market. On that same report, you can see specific examples of withdrawals on the eligible side. CNT Depository, INXI, shows eligible withdrawn 603,147.62. JP Morgan Chase Bank shows eligible withdrawn 159,493.2. Delaware Depository shows eligible withdrawn 5,999.85. These are not opinions. These are line items. They're printed in a formal depository report that the exchange publishes. And they represent real metal being moved by real institutions for reasons that don't get printed next to the number. Now here's the cliffhanger that most people avoid because it forces them to think like operators, not spectators. If the market is relaxing, why is metal being pulled out of the system at all? Don't answer yet, because the answer isn't one sentence. The answer lives in how silver gets used, where it gets refined, how many different parts of the system compete for the same bars, and who has the logistics capability to actually move delivery-grade metal from a COMEX-approved vault into a pipeline that turns it into something the real economy needs. To understand scale, we need London. LBMA's London Vault data for end February 2026 states that the amount of gold held in London vaults was 9,210 tons, valued at $1,546 trillion, equating to approximately 736,769 gold bars. And it states there were also 27,065 tons of silver, a 2.4% decrease on previous month, valued at $78.3 billion, equating to approximately 902,177 silver bars. That's the big reservoir. That's the global plumbing. And it updates monthly, 1 month in arrears, which means it's not designed to entertain you. It's designed to document reality on a timeline that doesn't care about your anxiety or your enthusiasm. It arrives when it arrives, and it says what it says. Now compare the emotional behavior of the screen with the slow truth of the vault. On a fast day, silver can swing dollars and percentages. On a slow month, silver vault tonnage can drift lower while the public is still arguing about chart patterns. Those two tempos create confusion for retail and opportunity for professionals. The professionals aren't smarter. They just read both clocks. Retail usually reads only one. Now we bring in the ETF wrapper again because this is where the mass public touches silver. Yahoo Finance shows iShares Silver Trust, SLV, at 77.76, down 2.33, 2.91%. As of 3:42:43 p.m. EDT, with previous close 80.09, open 78.03, days range 76.45 to 78.06, volume 27L560.508, net assets 46.25B, NAVI 75.58. That's the screen. Now recall the document anchor. The SLV fact sheet as of December 31st, 2025 prints ounces in trust 528,691, 365.40, and tons in trust 16,044.14. And here's the clean, audience-friendly meaning of that without drowning in digits. There is a massive amount of public silver exposure sitting inside a vehicle that trades like a stock, while the delivery mechanism categories that everyone watches in stress moments are much smaller. The ratio between those two numbers is not something you'll hear about on financial television, but it's something that matters enormously when the crowd decides to move at the same time. That does not automatically mean catastrophe. It means leverage and narrative can outrun logistics. It means a crowd can reposition faster than metal can be moved, refined, or fabricated. And in that environment, paper price can be accurate as a trading instrument while still being incomplete as a story of availability. The instrument reflects sentiment. The vault reflects metal. Both are real, both matter, but they answer different questions. Now we also need to talk about gold, because gold is the reference point, the control group, the senior sibling that tells you how the family is behaving. CME's COMEX gold stocks report dated 3/11/2026 with activity, date 3/10/2026, shows total registered 16,225,380,804 troy ounces, total eligible 15,995, 327.787, total pledged 1,017,146 Mo 1, for a combined total 32,127.08.91. Why does that matter? Because gold is treated like collateral, silver is treated like collateral and commodity at the same time. So when risk rises, silver often gets hit harder on the screen, not because silver is weaker, because silver wears two hats, and in a panic, the market rips one of them off first. Usagold's physical market snapshot language captures that relationship in one line. It states gold spot is trading at $5,187.60 per ounce, down $54.50, 1.04% on the day, while silver spot is trading at $86.05 per ounce, down $3.54, 3.95% on the day. And it states silver's steeper percentage decline pushes the gold-silver ratio to 60.3. That ratio is a translator. It tells you when silver is underperforming gold in the moment. And when silver is underperforming gold, it often means the market is behaving in a risk-off way, selling the higher volatility cousin first. Watch that ratio over weeks, not hours, and it will tell you more about market psychology than any headline. A rising ratio means fear is winning. A falling ratio means appetite is returning. And when that ratio moves sharply in either direction on high volume, it's usually not random. It's institutional positioning adjusting in real time, and the retail crowd tends to notice it 3 days too late. Now here's a piece of news that sounds like it belongs in a crypto video, but it belongs here because it's a story about how bullion demand is changing shape. Kitco's precious metals page includes a story stating Antalpha purchased $241 million worth of tether gold, ex-ad, representing 1.8 tons of physical gold, at an average price of $3,693 per ounce, and the position has gained over $100 million in unrealized profit. The meaning is not that you should run out and chase digital gold. The meaning is that new pipes are forming for bullion demand. Tokenized gold products, blockchain-settled bullion, institutional crypto-adjacent plays on physical metal. These are not fringe anymore. They are capital flows. And when demand gets new pipes, flows can change fast. When flows change fast, the paper layer moves first, and the physical layer gets stressed later. That is how modern markets work. The plumbing expands. The reservoir doesn't expand at the same speed, and that mismatch is what creates the tension you feel, but can't always explain. It's also what makes silver one of the most misunderstood assets on Earth, because the people trading it and the people using it are often operating in completely different realities. Now we zoom into the industrial side, because silver is not only a monetary metal, it's a working metal. It goes into solar panels, electronics, medical equipment, and advanced manufacturing. USA Gold highlights a detail tied to China's February data. It states China's National Bureau of Statistics reported February CPI rose 1.3% year over year, and it states that within the producer price breakdown, China's factory gate prices for silver refining plunged 16.9% year over year, while gold refining costs jumped 8.4% year over year in February. Read that slowly. Refining costs rising means friction in the pipeline. It means turning raw metal into usable form is getting more expensive. It means the people who actually process silver into industrial-grade product are paying more to do it. And that matters because it can keep real-world product prices and premiums firm, even when the paper quote is wobbling. The quote can say one thing. The refiner's invoice can say something different. And the refiner's invoice is closer to the truth of what it actually costs to get silver into a form the world can use. This is why, when someone says, silver is down today, the smarter question is, which silver is down? The quote can be down while the pipeline is tightening. The pipeline can be tight while the quote is down. Both can exist. And until you accept that dual reality, you will always swing between euphoria and panic based on a single number on a single screen. Now we have to be honest, because OG John AG isn't here to sell you a one-way narrative. Here's the bearish case, treated seriously, with the respect it deserves. Silver is volatile by nature, and the very data we're reading can also be used against a bullish story. The Kitco snapshot shows silver down 1.17% with bid 84.62 and ask 84.87, and USA Gold prints an even steeper daily decline in its snapshot, 3.95% to 86.05. CNBC's futures snapshot shows silver lower as well, and DXY shows an uptick. In a world where the dollar firms and risk appetite drops, speculative positioning can unwind. Open interest exists because many participants are holding positions, and when too many participants attempt to reduce risk at once, prices can fall faster than fundamentals would suggest. That kind of liquidation can drag SLV down with it, can widen the gold-silver ratio, and can create the feeling that silver is broken even when the physical system is merely shifting categories and documenting routine flows. And let's be clear about what that feels like from the inside. It feels like betrayal. You see the data, you understand the thesis, and the price still drops. That's not a bug in silver. That's a feature of leveraged markets. So the bearish warning is simple. Do not confuse a long-term thesis with a short-term tape. If you are over-leveraged, if you need a straight line, if you can't handle silver behaving like a high-beta asset during risk-off windows, then silver can punish you. And it will punish you precisely at the moment when you feel most certain, because that's when your position is largest and your patience is thinnest. Now step back, because the bearish case is not a death sentence. It's a risk disclosure with teeth. It's the part of the conversation that separates educated investors from people looking for confirmation bias dressed up as analysis. When you look at the total system together, you're seeing a market with two clocks, a fast clock that trades paper, futures, ETFs, and emotion, and a slow clock that documents vault holdings, warehouse categories, withdrawals, and industrial costs. On the fast clock, you can get days where silver is smashed because the dollar firms and the arena is crowded. You can get weeks where the chart looks terrible and the comments section is full of despair. On the slow clock, you can get monthly vault data showing silver holdings down 2.4% and daily warehouse reports showing 768,640.67 ounces withdrawn on an activity date, and industrial data showing refining costs rising plundered 16.9% year over year. You can get a quiet, persistent tightening that never makes a headline because it doesn't happen in a single dramatic moment. That's not a contradiction. That's a multi-layer market. And the people who survive this market long-term are the ones who learn to read both clocks without letting either one override the other. So here's what I want you to do after this video if you actually want to understand what's happening, not just react. Track three things separately. Track the quote you see on your screen. Track the warehouse categories that show what is registered and what is eligible. Track the macro pulse of the dollar. When those three line up, moves can be smooth. When they diverge, moves can be violent. And when they diverge for an extended period, something eventually has to give. And now we close where we started, because the opening hook isn't just a number. It's a warning about the modern structure. 528,691,365.40 ounces in trust is a symbol of how massive paper exposure can become. 78,347,462.573 registered ounces on COMEX is a symbol of how specific the delivery mechanism becomes when stress arrives. 27,065 tons in London vaults is a symbol of how deep the reservoir is, but also how it can drift lower quietly while the crowd fights over charts. Put those three numbers side by side, and you're looking at the architecture of a market that was built to be efficient in calm weather and fragile in a storm. That is the real story. Silver is not just a price. Silver is a system, and the system has moving parts that most people never bother to examine. Now let me bring it back to the channel risk, because it's the same exact logic. You don't wait for disaster to prepare. You prepare because disaster is always possible. If OG John AG 2.0 disappears because YouTube's systems decide the name has become a spam magnet due to clone channels, the people who prepared won't miss a beat. The people who didn't will lose the signal. And losing the signal in this market, at this stage, is not something you can afford. Not when the data is moving this fast. Not when the layers are this complex. Not when understanding the difference between a screen price and a warehouse report can change how you make every decision going forward. So subscribe to Financial Capital now, while it's simple, while it's clean, while you can still verify it without confusion. Share this with one friend who tracks silver but never checks the physical reports. And if you want a signal you actually watch the full breakdown, leave a comment that says OG John AG 2.0 in a way that feels like stamping your name on the ledger. Here's the final question I want to leave you with, because it's the only one that matters in the next volatility wave. When silver moves again, will you understand the headline or the mechanism behind it? This is OG John AG, always investing with logic, never hype. Stay precise, stay ahead.